Okay. Um, my wife likes to say we make dreams come true, but we're not in cosmetics. Our work is to change the financial system so it works for multiple stakeholders, only investors. I'll cover a variety of things, of definitions, backgrounds, what has been happening, what it's driving, and what is the opportunity. So, when we started 25 years ago, trying to convince the financial sectors how they looked at the earth, did they see it only as a risk or as an opportunity? That was really important before if you want to get buy-in. For those of you who don't know what is ESG or extra financial investment, these are various definitions. The definition that we use is the last one, that basically ESG questions, while you're trying to maintain profitability, are your products and services worsening, maintaining, or improving the social and environmental balance? Most companies are worsening. A very small number are maintaining, and an even smaller number are improving. But if you are maintaining or improving, you're probably incredibly resource efficient. You don't use much water, raw materials, energy, waste, etc., and you don't have such a high turnover in staff, all leading into much more profitability. This is basically the difference between ESG and impact. You'll hear that often. ESG is more liquid. Impact is less liquid, usually in private equity or alternative investment. ESG tries to have value over the long term. Impact tries to do it in the short term. ESG is more about avoidance and incremental improvements, and impact tries to be restorative in nature. ESG is somewhat measurable. Impact tries to be clearly measurable. And the main reason why so many people like impact is that it's not correlated. So when the stock market tanks, which it always does, the impact space is not hurt. But this is the main driver. Why is there so much interest in sustainability and impact? China's growth of 6 or 8%, if it's true, that translates that they will reach U.S. consumption levels by 2031. They might need 80 million barrels of oil a day, and then if you look at the other commodities, grain, meat, coal, steel, paper, etc., you'll see that they will, if this level of growth, inefficient growth of raw materials, they will consume so much. Then if you add India and the other 3 billion in emerging markets and us, you can see that's not possible to have this linear growth at this level of inefficiency. So what is the opportunity? The opportunity is massive resource efficiency. That is the big macro driver. We don't have enough in the world to fuel the economic growth at an inefficient pace. So where are we coming from? This is what I was dealing with when we started.
I will live each day as if I were the only one that mattered.
I will do anything I want to anyone who can't stop me.
I will regard each tragedy that befalls my fellow man as an opportunity for personal profit.
I will exploit the weaker and less fortunate.
I will remember that war is good for business.
And nice guys finish last.
I will invest with Wormwood Bain.
I will invest with Wormwood Bain.
Wormwood Bain.
Wormwood Bain.
Wormwood Bain, the stock fund for socially irresponsible investors, with performance that outpaces the market year after year. At Wormwood Bain, we invest only in the smartest, meanest, most ruthless businesses in the country. Companies that underpay workers, bust unions, export jobs overseas, use third world child labor, and ignore environmental regulations because they add more short-term dollars to the bottom line. And in the long run, we're all dead. So if your greed is bigger than your conscience, invest your money with Wormwood Bain.
Market savvy.
Socially irresponsible.
We don't give a shit.
I think they're also hiring for those of you looking for a new job. That's where the world was when we started 25 years ago. It's changed a little bit, not that much. And then we also had the financial crisis caused by the mortgage disaster, where people discovered that poor people with bad credit couldn't afford to buy a home, and saying, who knew? But our challenge has always been ignorance. It's never been that people fundamentally are not interested in sustainability. And how we got buy-in over the years is The challenge was always access. People with a lot of money are very isolated. The more zeros, the more isolation, almost like a Xanadu from Citizen Kane. We did find that pain is a very effective way in getting people's attention. If they continue in a certain direction and that pain is large enough, they will consider alternatives. But it's very important to clearly align the self-interest. Focusing on the moral imperative and not showing the self-interest, you will not get anywhere. And most important, show the money flows. So we always focused on the self-interest, opportunity, and money flows. And if you do that over and over again, multiple times, you will get behavioral change. One of our greatest challenge was the impact myths that we had to overcome. That impact is a charity, there's no returns, there's no deals, money losing, no scale, too risky, bad management, no track record. But if you look at the investment myths, they're even more colossal. I mean, all investment managers always say, we always hit our benchmark. A lie. Private equity funds always earn 30%. That's a whopper. That's a real whopper. And hedge funds always earn 30%. So if you're going to believe the myths, then you also have to start questioning the investment myths, because they are dealing with far larger sums. Most of the private equity funds don't get 30% for a long time. Most are much, and hedge funds were returning money because they were not achieving their returns. And then I always heard ESG data is not good enough. But if you look at the financial data, it's far worse. Look at the scandals, the China Hustle, the movie that was made, WorldCom, Enron, Parmalat, Madoff, RBS, the financial crisis, trillions wiped off. No one ever said, wow, we really need better financial reporting. And there's never been a single company in the ESG space that went bankrupt because of bad reporting. It was actually the analysts, the financial analysts, the ESG analysts, that predicted that BP was going to have problems because they spent 8% less on health and safety. And then I hear all the time, sustainable investment is risky, when the financial sector has actually paid more than $350 billion, closer to $400 billion in legal fees and fines, doing the risky stuff they did, which led to the financial crisis in 2008. The drivers, to sum up, are emerging market resources, resource inefficiency, wealth holders looking to integrate philanthropy and investment, a financial crisis, staff and clients looking for purpose. There isn't a lot of regulation. People think there's lots of regulation in Europe. That's not the case. A bit of stakeholder pressure, student employees demand on employers and endowment, wealth managers looking to engage with clients around impact. And most important, the business case has been made. If we look at the 20-year milestone, I'm not going to go into all of that because of lack of time. The most important, the most recent development is the Carbon Tracker report, which, if you don't know what it is, take a look at it. Basically, Carbon Tracker said, okay, let's say we have to stay at 2 degrees. We're not going to, but let's say we have to. How much carbon can we burn? They came to a budget of about 886 gigatons of CO2. How much did we burn already? How much do we have left? 565 gigatons. Okay, how much is left in the ground? 2,800 gigatons. Oh, that means that 2,200, close to 2,300 gigatons, you can't burn, but it's on the balance sheet, which means it has no value. That woke up a lot of people, particularly investors. And that's why you saw the whole divest invest. You can download the whole report on the Carbon Tracker. We look at the money flows, massive wipeouts in the past for the large oil companies, coal companies that basically have disappeared because they losing their market share. Many coal companies going bankrupt. They'll still have it for steel production, but much less and less for thermal. Then you've had massive inflows into liquid assets in environmental, social, and governance, or ESG. That has continued year in, year out. And even Larry Fink has discovered ESG and has made it a priority for his organization because they can make fees. The green bond market is exploding, constant more and more flows, more and more companies looking to fund production expansion through green bonds. And then you've had the Green Transition Scoreboard, which show there was close to $12 trillion going into corporate R&D, life systems, energy efficiency, green construction, and renewable energy over a 10-year period. But we still have a significant problem with fossil fuel, because in spite of the IEA report saying that we dramatically have to move away from fossil fuels to avoid catastrophic climate, we're not moving there fast enough. We need to go much faster than the music. It's not hopeless, but it's not hopeful. If you look at how the amount of money, not enough being poured in to address this particular issue. These are the 6 areas that you see a lot of investment going into: energy, food, water, healthcare, education, and transportation, particularly among investors and impact investors. However, if we look at all of this trillions, now close to $40 trillion in liquid assets going into ESG, what has been the results? Pretty terrible, pretty terrible. If all of this money was going in, why do we have so much climate change destruction, biodiversity loss, water shortage, food shortage, health crisis and diabetes, income inequality, pollution, and threat of war? So either that money is not going in, or the definition of what is an ESG is really very skewed. And people are realizing that now with the creation of net zero asset management. ESG, basically liquid assets, as it's done now, is a death march in the wrong direction, but slower. And if you look at the reality check, is that the ones doing the most talking, the ones doing the most are talking the least, and the ones doing the least are talking the most. So if you believe all of the World Economic Forum press releases around the 2nd or 3rd week of January, you'd think that everybody's pouring trillions into regenerative investment. That's not the case. The ones that have benefited from ESG are the fund managers, the institutional investment box tickers, aspirational club members, service providers, advisors, but society or the environment have not benefited at all, at all. So people who think that we're going to fix the environmental and societal problem by doing ESG, they're fooling themselves. We need basically a radical change, a moonshot. We need things going into restorative investment that fundamentally improves people's lives. And many of you are involved in that. If we look at the developments, we see there's so much activity because carbon has a cost now because of the Paris Climate Agreement. On top of that, when people look at, well, how much money is out there? Well, it's about 3.5 times the global GDP in wealth, according to Credit Suisse study, which is why you have these massive fluctuations. There's just so much money. On top of that, there's almost 40 trillion going to next gen. This is just for the United States in the coming 25, 30 years from the patriarchs to their children. And most of those next gen want their money to improve society, not make it less worse. But I think the greatest challenge for the financial sector, if they don't really embrace sustainability, they'll lose clients, but they'll also lose talent. We're seeing that now. The banks are stealing staff from one to the other because they can't keep the best and the brightest. The ones that stay are the civil servants. We have one of the greatest opportunities in the history of mankind at the moment, and particularly for Africa, because the public market in Africa, most of the companies are not getting their money from IPOs. We have if we focus on zero emission real estate, new and retrofit, public transport infrastructure, fuel-free energy, carbon sequestration, red and blue carbon, and invest in 2 of the largest employers in the world, which is small-scale agriculture and hospitality. That's where the jobs are. The jobs are not in IT. The jobs are not in car manufacturing. There's 1.4 billion people who work in hospitality and small-scale agriculture. But most investors are focused on the app that will give them 10x. Water, there's no substitute for water, affordable healthcare, climate resilient cities, and a living wage. If we focus on this, you will transform Africa completely. So if we look at, as I was saying, some of the solutions, public transport infrastructure, it's a $2,300 billion industry each year. The community banking system is a $2,500 billion industry. The secondary market for the development finance institution, fuel-free energy or renewable energy, social stock exchange, and second generation engagement. I like public transport because it ticks all the boxes, yet very few institutional investors really focus on this space. We have a fundamental change and the herd is forming. We are able to create a sustainable investment portfolio if we want to. If you don't want to, you don't have to. And I like to look at ESG. People think it's a niche market. It's not a niche market. It's a big party, and we just got here early. You know, sometimes you go to a party, nobody's there, and you say, oh, this is going to be really boring. But because you're there, you have the first mover advantage next to the food, next to the drink, and as people start coming in, and then you have a great time. My apology for that text double click. Real estate. If you look at the Empire State Building, the guy who owned it, Anthony Milken, was a speaker at our conference. He was not a sustainability fan at all, but he did the math. He did the largest green retrofit in the world, $525 million, paid for it himself, retrofitted the building, and then ultimately sold it for a lot of money and was able to charge much, much more. The world's largest UN SDG real estate project is in Thailand by a Thai woman who's building a complete urban, resilient, low carbon community without air conditioning, intergenerational. Energy, wind, tidal, solar it's now able to compete with fossil fuels, and that is only going to increase. Next steps are in grabbing hold of some of the low-hanging fruit of real estate, mortgages, retrofits, ESG funds, second generation engagement, private equity. There are just so many opportunities, and particularly in Africa, which, as I said, it's not, you know, it's not the world's largest public market. It's quite small, and most companies get their investment from debt or equity. And Africa, I think, has the greatest potential there. But we need less people cutting ribbons and more people actually digging holes. We have enough people cutting ribbons. And we need to shift away from hunting to farming. The financial sector are hunters. They're incentivized for short-term behavior. So as long as you keep giving them short-term behavior incentivization, they'll keep doing that. They've pretty much decimated much of the wildlife, and we need to replenish. And farming, physically and spiritually is a much better focus. So what can you do? To paraphrase Yoda, do or do not. There is no try. We need to also stop all of these silly polar bear photos, which have nothing to do with the business at hand. And every investment company has polar bears or smiling children in Tanzania drinking milk as an example that they are committed to restoring the environment. It has nothing to do with their investment, and we need to get away from that. And people are tired of this greenwashing. So my time is up, and if you want to join any of our events, you're more than welcome. I apologize for the flickering of my camera, but I don't seem to be able to adjust that.
Thank you very much, Robert.
I think I did okay on time.
Yes, you're doing great. And let me just see my camera here. So thank you very much, Robert. And just to update everyone, Robert is the chairman of the TBLI Group. As mentioned, he's been driving impact investing for over 25 years. And the TBLI Group has over 40,000 members part of it, and includes some of the leading impact investors around the world. So I'd like to give the audience a few minutes. If you have any questions, we have a Q&A session over here. And we have a question. First of all, if anybody wants to come on stage, you could raise your hand, and we could bring you on stage, or you could put on the right-hand side. There's a Q&A area where you could post a question, and we'll take a few minutes to answer. So, Robert, there's a question from Regina. Can you speak to us about your expectations for this current U.S. administration and how it will impact climate agenda set forth by the courts?
Well, I mean, you only have to look at the decisions made. It's not the same focus as the previous one. They actually believe that there is a climate risk, but there's still a lot of division in the politics of trying to get things done. So there's no comparison between this administration and the previous administration as it relates to climate. I do see a lot of positive developments around that. My issue is that no government anywhere except maybe Sweden, is really putting the price of carbon through a tax or other system at what it should be. The pricing of carbon is very, very low. I believe that we should do a cap and share system, which means every consumer gets a carbon allowance. I know it's a complicated technology issue, but if you use your bike or you don't drive a big SUV, you can earn credits. If you want to drive your big SUV and you want to, use up a lot of your carbon credits and buy more, you have to buy more. This way, at the moment, the consumer is not included in this whole issue. And unless we put a price on carbon that is realistic, it's not going to change fast enough. There are some, announcements. The net zero asset manager say we're going to cut carbon by 50% by 2030 and 100% by 2050. Who of you are going to call them in 2030 or 2050, say, hey, you know what, you missed your target? So it doesn't mean anything, these far-reaching targets. We need action now. I mean, we need dramatic action now. And I don't know if we're going to be able to make the change. I'm a big fan of regenerative agriculture because you can sequester carbon at a very large scale by restoring the soil. So I work a lot in that space. The same thing of restoring carbon, restoring ocean areas. So the difference is night and day, but is it enough? If you buy a bicycle in Europe, it's 21% VAT, 21%. You buy an airline ticket, there's no VAT. Where is it not logic in that? They can't even get an agreement to start charging VAT on airplane tickets or taxing kerosene. So there's very little political leadership to really make the difficult decisions, because they still want you to be able to go away on holiday with EasyJet for 10 euro or 50 euro.
Thank you so much.
Sure.
So I think, first of all, if anybody has additional questions, okay. I see there's, we have a question from Daniel D. Ryan, okay, and then we'll take one more after this, if there is one. And then after that, we will have Zach George speak.
Oh, that's cool.
And we could have networking afterwards, and you could personally speak with Robert as well on the networking floor. There's a special area for him. So Daniel D. Ryan has a question. I lived in Malawi, Africa for 12 years and saw firsthand the desperate need for equity capital. Our firm is launching a 100 million impact innovation VC PE fund targeted for sub-Saharan Africa. And Daniel, do you have a question? Do you have any recommendations of sectors that he should be investing in?
Does he have the 100 million? I think that's going to be the hardest part, because first-time managers have a very difficult time in raising money. There's a lot of first-time fund managers. If Daniel has the money, then great. I can't talk about Malawi. I'm not an expert on Malawi, but the sectors that a lot of institutional investors are looking at are food, water, education, housing, transportation. It's the 6 ones I was showing. That's where a lot are looking at. But it's very important that farmers who, 70% of the food produced by small scale farmers, but 70% of the poverty is also with the small scale farmers. So we need to make sure that they earn more money. It's not, and we're just squeezing them to death. So anything that improves the income of small scale farmer is excellent. And also hospitality, particularly if it's done culturally authentic and the hotel is low to zero carbon in its development. That's also an area where you can attract investment. Again, I don't know what the pipeline is in Malawi. I've never been there. I'd have to do some research, but just looking at what others are doing, it's pretty much the same everywhere. I just had a meeting with a regenerative agriculture company and one of the largest Swedish family offices. They created a whole vehicle only for food. So that's a very, very important area. But again, people might have other needs in Malawi than specific, improved income for the farmers. But for me, that's very important. And water and education and housing. These are the areas that most institutional investors are looking at in realigning their portfolios around sustainability.
Wonderful. Thank you so much, Robert.
You're welcome.
Really appreciate your talk and your answers here. And everybody again is welcome to network after this upcoming session with Zach George and to meet Robert in person at his booth. And Robert, thank you so much again. And we'll bring Zach on stage. Come on board. And Robert, I'll see you soon.